With all these expert insights, we hope you now have a better understanding on how to achieve excellence in a pandemic. Our closing keynote will address how the global business world is responding to COVID 19. Our guest speaker is Professor Hal S. Scott, Chairman and President of the Program on International Systems, PIFS, and the Emeritus Nomura Professor of International Financial Systems at Harvard Law School. Over to you, Hal.
My talk today is on the corona crisis, the impact on the financial sector, and the government's response. I want to start by looking at the huge economic impact of corona with actually some signs of recovery now. A significant portion of the US economy was closed down. In the first quarter, there was a sharp GDP fall of 4.8%. But the Fed projected in June 10th that GDP will contract by 6.5% this year, which was less than some people anticipated, and then grow at 5% in 2021. Both the Fed and I think the Wall Street Journal's June Economist Survey says this recovery in the third quarter will be a swoosh, not a V. We've experienced a devastation of small business. 50% of the workforce is represented in the US by small business, 44% of GDP. Many of these businesses were closed, many of them permanently. Had a 13.3 unemployment rate in May 2020, down from April. Fed predicts that by the end of the year, it'll be at 9.3%, going down, that is unemployment, but still extremely high. We had a large drop in the stock market when COVID hit, from a high of the Dow Jones Industrial Average of about 29,000 in February to a low of 18,000 and something in March 23, a loss of 38%, but it's now bounced back. As of last Friday, it was at almost 26,000, which shows you of a loss of only 13% during the COVID strike. This is kind of an upward market with a downward economy. There's a big disconnect here. Maybe the market knows that things are going to get better. Maybe the market's wrong. As you know well, Brent crude oil fell to about $19.33 on April 20th from a high in January of $68.91. It's bounced back as of June 19th to $42.19. Lots of bond downgrades in the United States. Corporate credit markets were hard hit. One significant fact, which I'll elaborate on a bit, is that there's no present concern with bank solvency or stability. So fortunately, bank capital, here measured by conventional common equity tier 1, has been substantially increasing since the credit crisis of 2008. So it was high enough to absorb losses during COVID. At least we hope so. One of the things that was not totally anticipated was that there was a big influx of bank deposits, just the opposite of 2008, where there were withdrawals. And this represented a kind of flight to safety from other more risky assets. Another kind of pulse of the banking system is the degree to which they would borrow from the Fed at the discount window. And you see a sharp increase at kind of when COVID hit, but that was largely because the Fed encouraged the banks to borrow so that it would not appear to be a stigma later on. As we'll see a little bit later, that borrowing has come way down since then. The last measure here is in April, but it's far below that right now. This looks at the credit default swap spreads. of banks, and basically leverage ratios. They're a little bit higher than the start, but they're way down, which basically says the market doesn't think that these banks are too risky, given the spreads that they're charging for credit default swap protection. Now, one thing to keep your eye on is that at the very beginning of COVID, lots of borrowers or clients of banks who had the ability to borrow drew down on their corporate lines. And it was quite significant. It totaled $3 trillion, which is a big number for the banking system. So the question is really in the future, are all these people who borrow money going to be able to pay it back? The concern is that although this was not a banking crisis at the start, the damage to the real economy could eventually make it so. We hope not, but we have to keep an eye on that. So I want to turn now to the Fed measures, the Fed macro measures that they adopted on March 15th. The Fed lowered the federal funds target rate by 1% to a range of 0.25 basis points. They lowered the discount window rate, extended the term of the rate. Already talked about the Fed wanting to encourage the use to show there was no stigma. And very significantly, the Fed committed to make massive direct purchases of treasuries and mortgage-backed securities that are guaranteed by the government. So those total commitments were $700 billion. The purchases of the mortgage-backed securities brought down the 30-year fixed rate on mortgages from a spike of 3.65% to around 3.5% today. And the Treasury 10-year came down from its high of 9.7% to 0.69%, making it cheaper for the government to borrow. The Fed created at the same time swap lines with other major central banks, which have been expanded. Those swap lines are over 446 billion. Now, luckily for all of us during this period, there was a very low risk of inflation, so that this massive provision of liquidity did not cause concern about inflation. In fact, the core CPI, the Consumer Price Inflation Index, actually continues to fall now. All of this has increased the total assets of the Federal Reserve from just around if you go back, let's say, to the beginning of the crisis, we were a little bit, over 4 trillion, and we're now kind of in the neighborhood of 7 trillion. And quite significantly, you see just last week that this rise has started to tail off, okay? So some people are predicting that expansion would have been, up to 10 trillion or almost 9 trillion, but that did not happen. These purchases actually had their intended effect. Here you see the actual purchases of securities of the New York Fed, which kept coming down, and by May, they were no longer significant. This slide shows you the U.S. Treasury bid-ask spreads. Again, this is a measure of liquidity in the Treasury market, and you see those contract. So all of this Fed money was making it easier for the market to trade and provide liquidity to the Treasury market. The Fed adopted other measures other than financial intervention. So they relaxed various parts of capital requirements. They didn't eliminate the overall ratios, but they kind of made some individual adjustments on how to measure credit losses, how to account for derivatives. Very significantly, they said that you don't have to count as assets for purposes of the supplementary leverage ratio of 3% U.S. Treasury securities that you hold or deposits of the Federal Reserve, which the Fed estimated would actually have the effect of decreasing Tier 1 capital requirements by 2%. There were also some relaxation of liquidity requirements and the removal of limits, that should be limits, not limits, on daylight overdrafts. Those are the ability of banks to transfer funds on the Fed wire system, giving them the possibility to, in effect, get credit by overdrafting their accounts. Now, as you may know, the Fed conducts stress tests on our important banks. These stress tests were actually already ongoing or actually just commencing, but the preparation had preceded COVID. And so in these stress tests, the Fed posits a very extreme scenario. And so if you look over here at the adverse scenario, that here's what they thought unemployment would be, here's what they thought real GDP growth would be. Actually, COVID turned out to be more significant than even the extreme scenario before COVID hypothesized. So the Fed is now dealing with the fact that the results of these stress tests, which they already have not reflected COVID. And so what did they do about that? They did not want to rerun the stress tests. They didn't suspend them as Europe did. But their plan, as last indicated, will be they'll require capital based on the scenarios that were actually put into the stress test. But as a supervisory matter and going forward, they're going to monitor sort of bank by bank and see what they have to do. The net impact of falling short on capital would be to restrict bank dividends. The banks have already agreed it by themselves not to do share buybacks. So later this month, we'll see much more about how the Fed's going to deal with COVID for the purposes of the assessing what the impact of the stress test should be. Now, this is a long, complicated slide, but it's reflecting a lot of different things that are going on. The Fed has devised a series of lending facilities in response to the crisis, primarily addressed to stabilizing financial markets. The top four on the slide were deployed in 2008, which were designed to stabilize the commercial paper markets, trading markets like stocks and bonds, the money markets, that's the money market mutual fund liquidity facility, and securities markets, that's a term asset-backed securities loan facility. So some of these were launched very quickly after they were announced. This primary dealer credit facility and the money market mutual fund liquidity facility were quickly put in place because there was a lot of destabilized activity in those markets. In fact, on the money market mutual fund side, there was almost a mini run. But others, like the commercial paper funding facility, were announced in March, not launched until April. And this last facility, which is the primary market corporate credit facility, which is to support the corporate bond market, both in the primary and secondary market, is only partially launched. It announced back in March. Part of it, the secondary market part, was launched on May 12th. What it's done so far is to buy exchange traded funds. In fact, the Fed announced on June 15th that it will actually construct its own ETF out of a number of different bonds that are in the market. Now, I think that the big point of these facilities is that their mere announcement stabilized the market. So it really raised the question of whether the Fed actually had to buy anything, or just the announcement would be enough said that the market would stabilize and be able to supply funding on its own. More on that in a little bit. So in the money market funds, as I've already said, there was a mini run. In particular, two money market funds that were affiliated with banks found themselves dealing with heavy outflows. And by the way, the money market fund business or segment is broken down into prime funds and non-prime. Prime funds are funds that hold assets other than government assets, particularly commercial paper. So the difficulty was in the prime market of mutual funds, not in the government. So as I said, two bank-affiliated funds had difficulties. The banks had to sort of, support them. As we see here, this is this, huge outflow from the funds, again, just prime. And the prime funds have sort of come back more recently. Now, overall, interesting, the total amount of money invested in money market funds of all kinds actually increased during the crisis. Well, it was basically due to people liquidating more risky assets like stocks and bonds and putting them into government-only money market funds. So the actual total size of the money market funds has increased from before the crisis was 3.6 trillion to now 4.7, but all of that net increase is due to governments. So this slide shows you how the commercial paper market was basically stabilized, issuance increased, rates decreased. The same experience in the corporate borrowing market, which, as I said, was only recently instituted, but the Fed's facility was only recently. But before the facility ever came into effect, you see these rates decreasing from the mere fact that the Fed said they would support the market. That was both true of higher rated corporate bonds and junk bonds, the less lower rated bonds. So the entire corporate bond market stabilized. So now I want to turn to another part of the response, not the Feds, but the Congress. So on March 19th, the Congress appropriated $454 to $500 billion, depending on how the Secretary uses this money, of Treasury to make loans and loan guarantees to support eligible businesses and states, that is, states of the United States or municipalities. Any of these programs had to comply with so-called 13.3, that's a section of the Federal Reserve Act's restrictions, which were actually imposed during the Dodd-Frank, in the Dodd-Frank Act of 2010. So these require Treasury approval, collateral requirements, and solvency requirements. It also restored powers to the FDIC to raise deposit rates and allowed Treasury to guarantee that the money market funds, these were powers it had before Dodd-Frank, they were restored, not needed to use. So all in all, this was a $2 trillion bill, but for purposes of our focus is that $454 billion to support the Fed's facilities and another program of the Small Business Administration, which is now known as the Paycheck Protection Program. So I just want to talk a little bit about that before I get there. One of the first facilities that the Fed created after the announcement or after the passage of the CARES Act was a facility to support state and municipal governments. That brought down their rates even before the Fed has made any actual purchases into that market. Again, the announcement effect. So this is a bunch of data, which I'm obviously not going to go through here, about how much the Fed lent in all of these programs from their time of commencement to now, in June, or almost now, June 17th. And I want to focus on the facilities that I talked about. There are other things here. Here's the primary credit. You can see how the discount window is kind of, started up here at, at that stimulus of 50 billion. It's now, down to almost 7.5 billion. I want to focus on the Fed's facilities that we've talked about that they created. And the total amount that they've lent through these facilities as of last week was $100 billion. Now this compares with the potential lending of almost 4 trillion because they got 454 billion from the Congress. The Treasury could allow the Fed to lever that 10 times, as both Powell and Mnuchin have said many times, which would total up to 4 trillion capacity. But up to this point, they've only lent 100 billion, which has led many people, including myself, to say, why aren't you doing more? I think, the question is, if the announcement effect is good, why do you have to actually buy? But as we'll see shortly, for one of the most important programs that won't hold. Okay, this is the Paycheck Protection Program that was part of the CARES Act. This is not a Fed program. This is a government program. Initially, it was for something like, where we go back here to, I don't know, the chart, well, it doesn't say here, but I think the initial amount that was put into this program was something like $300 billion, and it wasn't enough. It was exhausted almost in the first few days, so it was topped up by a later second appropriation. So the total amount in this program is $698 billion. This only applies to employees under firms with 500 or less employees, but is a very important part of the private sector. And basically, it supports and focused on payroll. It only allows coverage of certain, what I call core expenses, low interest rates, 2 years to repay. And then very significantly, although these are loans, you get forgiveness if the money's actually used for keeping people on your payroll or getting them back if they've left. There have been many issues with this facility, how much money. Originally, it was all snapped up. Actually, here's the initial funding. It was 377. It's now 698. But now there's money left here because people are unclear as to what the terms of forgiveness will be. And the administration sort of jawboned a lot of the people who got this money, larger corporations, to give it back. So people are now afraid if they take it, somebody's going to question whether they really, were qualified to take it. The coverage is limited again to only 500 employees in a firm. There were problems of slow distribution of funds, the fact that of the funds, as I've already alluded to, big business got a lot, favoritism, where the banks only sort of giving loans to their customers, and of course there are, in a program of this size, false claims. So I think the most important thing left on the table here is for the Fed support of small and medium business to go side by side with the Payroll Protection Act, which is only the very smallest business and only a limited coverage on expenses. And there's been a lot of back and forth about the design of this. This is clearly fiscal in nature. The Fed has never done anything like this before. It's supporting the real economy. This is not going to help by just announcing, because it's not a market. These are businesses that actually will need the money. There's 600 billion here, backed by 75 billion of Treasury investment. there's a question, I think right now, you look through the terms are difficult. The banks don't seem to be particularly interested in this. The amount that's being furnished is not large. So right now, it looks like people don't want to borrow and the banks don't want to lend. Now, they just instituted the program a few days ago, so we don't really know, but my guess is that it's going to have to be redesigned. So conclusions for the US, and then I'll just say a few things about Europe and emerging markets. This has been a very different scenario than 2008. It was the real economy here, not the financial system, although we worry about, will the real economy come back to bite the financial system? There's no real concern with moral hazard here. The virus losses were completely unanticipated, and the support is unlikely to result in more risk taking in the future. The Fed's macro measures stabilized the government financial markets, and Fed facilities have also stabilized private financial markets. And I've talked many times about this through the announcement effect. The major issue facing us is the recovery of the real economy in the United States and, by the way, elsewhere. And the two facilities or two actions that are aimed at that is the Small Business Administration Paycheck Protection Program and the Fed's Main Street facilities. So it's unclear whether they will be sufficient to hold small business together through the shutdown and the slow reopening. Of course, the biggest unknown is the future path of the virus and science to contain and treat it. So let me just say a few things about Europe and emerging markets. So Europe had a stimulus package of $540 billion. This compares with our stimulus package of $2 trillion. They recognize this was far short of what they needed, and they have debated doing an additional proposal. This would cause them, require them to raise money, which is, of course, reserved currently generally to the states or the member states. And so they're debating whether to do that by authorization of a new $750 billion. And they're meeting right now to see if they can agree on that. Now, individual countries, of course, have taken measures. They've made spending increases. They've had tax reductions. They've done all sorts of other things. But I think it's for the weakest states, the hardest hit states, Spain and Italy, they really do need some EU support, because they have a limited ability to deal with this, but through their own fiscal measures. The EU did relax some rules about, limits on spending in these countries, the so-called Stability and Growth Pact, and prohibitions that normally apply to prevent government for subsidizing industry, which in this case is quite necessary. The principal responder in Europe is the Eurozone. In the Eurozone is the European Central Bank. They, like the Fed, have engaged in massive asset purchase programs. They lowered their rates. They established new lending facilities to support, the financial system. But they have limits on what they can do. In fact, in the setup of the European Central Bank, the lender of last resort function is actually limited, is not given to the European Central Bank, at least at some now, but resides in individual central banks. So kind of programs to support the economy in more specific terms, like what the Fed did, is really within the powers of individual central banks, not the ECB. The ECB can kind of, supply liquidity to the entire market. So in emerging markets, there was a flight from emerging markets, people trying to get out of their government bonds. This increased yields on existing debt and interest on new issues. There was currency depreciation as holders of these assets sold their assets denominated in local currency and rushed to the safety of dollar-denominated assets. There were the demand for exports obviously dropped off, including tourism and oil, by the way, as the destination economies for these exports closed down. In March alone, major emerging economies lost more than $100 billion. So the IMF stepped in to provide financing of $100 billion, but this falls far short of the $2 trillion that the IMF has identified as necessary. And this kind of capability is going to require support from the funders of the IMF, obviously. There's a specter of sovereign defaults. Argentina has traditionally led the way here. They've defaulted again on their debt. Now, the better news is the funding conditions for emerging market have begun to normalize between the beginning of April and mid-June. Emerging markets raised more than $83 billion in the international bond market, partially reversing these March outflows, which we have talked about. Mostly investment grade countries, but some non-investment grade countries as well. So that's my presentation. I'm happy to answer any questions if I can hear you ask them. Thank you.